Ladies and gentlemen, let's move on to the plenary session in which we are going to hear three outstanding research papers related to the topic of the conference. We have three papers, two of them dealing with the question, the debate on how to design regulations, in particular capital regulations, in a counter-cyclical way. And another dealing with the behavior of banks in interbank markets and in terms of their liquidity behavior in times of financial stress. The way I would like to organize this session is that we have all three papers presented in a row. Each presenter has up to 25 minutes to present the paper. And instead of doing at the very end of the session a classical discussion, I would like to have a few questions from my side, but then I would like to move to a moderated session. So I would very much like you to be engaged in the discussion and have an interaction between the podium here and you on the issues raised of the papers, be they more specific or be they broader on the policy context. So I very much invite you after the presentation of it to join this, this moderated session very actively. So having said that, come to the first speaker, who's Charles Calomiris, who will talk about what he calls a natural experiment in UK capital regulation.
Good morning, everyone. Thank you, Philip. It's a pleasure and an honor to be here. Thanks to the organizers for putting together what's already a very impressive conference in a wonderful venue. Since it's my first time at Bocconi, congratulations on what a wonderful university. The topic, of course, is a topic that first needs to be defined for those of you who don't make your living thinking about banking regulation. Microprudential regulation, we're familiar with, we have a long history of it. The goal of microprudential bank regulation is focused on the individual bank. It's focused on the health and safety of the individual bank. The goal of macroprudential regulation is to use the regulatory tool that's been traditionally used, the prudential tool, for purposes of microprudential regulation to accomplish a macroeconomic objective having to do in particular with credit. So that one of the key ideas of macroprudential regulation is to use regulatory tools to accomplish a macroeconomic objective having to do with financial stability, where the instrument is the macroeconomic credit supply. And so the key tool that I want to focus on as a macroprudential device is capital requirements. The idea is, what do we know about the effectiveness of capital requirements on banks to affect aggregate credit? And of course, this isn't just a hypothetical idea, because under the current Basel III standard, we're envisioning the use of capital requirements both as a cooling device on credit during boom times and as a credit supply relaxation device during times of credit crunch, let's say during a recession. So this is already, if you like, part of the regulatory apparatus which now is going to have to be implemented. We focus on two questions in this paper that are the fundamental questions, I would say, in challenges in thinking about macroprudential regulation. The first one is bank lending actually affected by changes in regulatory capital requirements? That is this an effective tool, whether from a microprudential or a macroprudential standpoint, on individual banks? The second question is, even if it is an effective tool in individual banks, does it actually affect aggregate credit in the system? Now, you could imagine that affecting regulated banks' credit growth through their capital requirements might not be enough if there are substitutes for regulated banks' credit. Call it the shadow banking system, or it could be bond markets or equity markets. But a shadow system that's not under control of the regulator, that might substitute for the contraction in credit that's produced by, let's say, an increase in capital requirements on the regulated banks. That phenomenon is typically called leakage, by which is meant that even though you are having a gross effect on regulated banks, the net effect might be much smaller as a result of this leakage, of this fact that non-regulated banks are stepping into the gap produced by the increased restrictions on capital of the regulated banks. So those are really the only two questions that we're going to focus on, and we'll do them in sequence. In case you didn't think this was an interesting thing to focus on, we spend some time in the paper talking about our motivation and how much policymakers, especially, I was at the Bank of England this past year, and my co-authors and I did this work at the Bank of England, how much, in particularly the British are concerned about this, and I'll explain why. Effectively because so much of the banking system operating in the UK is not actually under UK capital regulation. And so this question of leakage especially is of major concern to UK regulators. The good news is, by being at the Bank of England, you get access to a unique and not public database. And the second piece of good news is the UK implemented a unique regulatory regime, which creates variation in our sample of banks that we can exploit. So in case you're not familiar with it, and I wasn't prior to going to the UK under Basel I, used capital requirements as a microprudential tool and varied substantially the capital requirement ratios, minimum capital requirement ratios applied to its regulated banks. I'll talk about that variation in a minute. And then at the same time, another thing that's going on in the UK is that there's a large number of unregulated branches of foreign banks. So there are really, from the standpoint of our study, three kinds of banks. There are domestically owned UK banks that are under UK capital regulation. There are foreign-owned subsidiaries that are under UK capital regulation. And there are foreign-owned branches operating in the UK that are not under UK regulation. So that means that a second nice coincidence of the UK's regulatory regime is that we have both regulated and unregulated banks, so the notion of leakage is particularly salient. Another aspect about the UK experience, which isn't on this slide, is that they have very detailed data that are available about the composition of bank lending. And we're going to be able to use that to control for loan demand variation in the bank that is experiencing a change in its capital requirement ratio by knowing at some great, very granular detail the sectoral composition of the bank and being able to control for sectoral shifts in loan demand, which affect its loan demand. I've already described this and the structure of these three. Here it gives you just a very quick picture of how different the capital requirements could be for banks. Notice that unlike most countries where they were applying fairly much across the board an 8% risk-based capital requirement, that's the minimum in the UK. The average is 10.8% with a standard deviation of greater than 2 and with a maximum of 23%. So you can see substantial variation from that minimum of 8%. Secondly, the changes are quite frequent, as you can see. Many banks are experiencing one change, a large number are experiencing 2 or more changes during our period, which is 1998 to 2007. A first question that we explore is, when you look cross-sectionally at the banks, can we make sense out of these differences in the average capital requirements of a particular bank over time? This is a little bit peripheral to the regression analysis, so I don't want to spend a lot of time on it. But the reason it was important is that the FSA had explained to us what the basis was for their add-ons. And the basis under Basel I was that credit risk was already covered by the 8% requirement, but that market risk and operational risk were not. And so the additional add-ons were related to perceptions of managerial quality especially. So you wouldn't expect them to be very correlated with credit risk differences per se. To give you a little bit of foreshadowing, they are not very correlated in the within bank variation. In fact, they're not correlated at all with credit risk differences in terms of within bank variation. But there are some interesting connections across banks. That's not surprising since managerial issues and operational risk might be relevant. So just to give you a sense of the cross-bank correlation, the higher your write-offs, the more of an additional add-on you were likely to have. Again, these are all cross-sectional characteristics. The larger your size, the lower the capital requirement add-on. The more you fund yourself with non-retail deposit debt, the higher your add-on. That's considered an operational issue or a funding liquidity risk issue. And the more your loan portfolio is sectorally specialized and therefore less diverse, the higher the add-on. So these are things that we were able to identify. Of course, then you could ask, what about the within variation? We spent some time talking about this in the paper. We're not able to identify any correlates, either contemporaneous, lagged, or leading, that really explain the capital requirement changes. And so we're going to regard them as exogenous with respect to the loan supply of the bank. We're going to control for a bunch of other factors, though, that might affect loan supply, and we're also going to control for loan demand explicitly by building an indicator of loan demand, as I said, based on sectoral composition of the bank's portfolio. First thing to note, you may be surprised by this graph. Capital requirements, on average, varied over time in a procyclical way. That doesn't mean they were doing macroprudential regulation, but it does mean that the regulation, thanks, you read my mind, I appreciate it. It does mean that something about the microprudential regime caused the regulators to vary, on average, capital requirements in a procyclical way, and actually very much in accord with what you'd expect under Basel III. So remember, there's no real recession happening during this period. This is growth recessions, and the bandwidth of change is a full percentage point on average. So the 2.5 percentage point change over the entire cycle envisioned by Basel III probably maps very closely into this 1% change over the growth variation that we're seeing. Moving a little bit faster, 3 things have to be true for there to be an effective capital requirement consequence for the loan supply of a bank. First thing is equity has to be a costly source of bank funding on a risk-adjusted basis. And the basic theories of this in the last 30 years of corporate finance revolve around issues of either costly state verification or signaling having to do with adverse selection. So the theoretical contributions, Gale and Hellwig, for example, in 1985 on costly state verification, and Myers and Maslov, 1984, explaining why banks do have a higher cost of equity finance. Now, we're going to just note this because this is a necessary condition. So if we find big effects on bank behavior, that means that this must be true. I note that because there's been some discussion recently about whether it is true. So our evidence is direct evidence that this must be confirmed. Secondly, capital requirements have to bind. All banks, of course, always maintain a buffer in excess of their minimum capital requirement, but that doesn't mean capital requirements don't bind because the buffer is a voluntarily chosen amount, and if the capital requirement changes, if the buffer remains more or less constant, then that means that you have a binding effect on loan supply coming from the increased capital requirement. We're going to show that that is in fact the case, and that confirms a couple of studies by Alfon et al. And also Francis and Osborne. I do want to just mention in passing, there's an interesting aspect of this, which is larger buffers do not necessarily mean a less binding effect. In fact, in the corporate finance literature, people have found the opposite. generally speaking, which is when buffers are larger, that means you have higher external finance costs, which means that maybe the reaction to a capital requirement increase might be even bigger. And actually, we end up finding that in this paper. So you shouldn't presume that a higher buffer means a less binding effect of an increase in the requirement. In fact, the opposite seems to be true, confirming a lot of previous work from a different context. This gives you a little bit of a sense for, this is an aggregation of the lowest quartile of buffers. So it's an aggregate of a quartile of our sample. So you can see that buffers, when capital requirements go up, capital ratios also go up, even though there's a significant buffer. And then, of course, there has to be, for this to matter from a macroprudential standpoint, there has to be limited alternative funding, and we're going to be investigating that to see what the effect is on the substitute banks, which are the unregulated branch banks. Given, in the interest of time, I'm just going to very briefly point out we have a way of controlling for demand based on sectoral composition of the bank's loan portfolio. The main result here is, in the first question, for the regulated banks, does an increase in their capital requirement cause their lending supply to be reduced? Loan supply, because we're controlling for demand here. And the answer is the effects are very large, ranging between these coefficients, negative 0.07 and negative 0.09. At negative 0.09, that implies an elasticity of -1. And that means that if capital requirements increase by 1%, loan supply falls by 1%, which is what you might expect to be the maximum effect in some sort of static sense on a balance sheet. We were surprised at the size of these effects. Also, I should mention now, in our follow-up paper, we've explored whether this varies across banks according to the internal capital markets they are involved in, which is not part of this first paper, and we find that it does. So as you would expect, banks that are involved in global internal capital markets have sizably smaller, much smaller effects, about 2/3, though, of this magnitude, which is still quite large. We have lots of discussion of endogeneity. In the interest of time, I'll just say that the key point here is that we do find, for example, that both lagging indicators of loan quality, non-performing ratios, and leading indicators of loan quality are important to control for as additional effects on loan supply, in addition to loan demand. But the changes in capital requirements are uncorrelated with those, and they have no effect. So controlling for this has no effect on the regulatory change. So if you're thinking, as we were sort of expecting, that we would find that this would mitigate the effect of the capital requirement changes, expecting the two to be correlated, they aren't. Interestingly, when you disaggregate, you do find, so now allowing the effect of capital requirement changes on loan supply to vary according to some things like bank size or the size of the buffer, we find that the banks with the higher buffers actually exhibit relatively large effects. In this study, we don't find our measure of size to matter, but we do find in subsequent studies when you have other variables included, I mentioned, for example, internal capital markets, you are able to find differentiation according to that variable. So I'll skip through this. The second question is, do unregulated banks substitute on the margin? Here what we do is we instrument the regulated banks' change in loan supply. So we instrument the change in loan supply with their regulatory requirement change. And then we look at whether unregulated banks increase their loan supply. And what we find is that they do, and especially if they're operating in the same loan sectors. So that's quite, I think, a nice finding, that it is also much stronger when you take account of the fact that the banks are competing in a sector that's dominated by one of the banks that's experienced an increase in its capital requirement. Again, in the interest of time, I won't mention much except to say we talk about the aggregate bank response of the unregulated group, but then we also have what we call the branch-specific reference groups, which is looking at the branches that are most competitive with the bank that's experienced the regulatory requirement increase. And here we're finding the very large coefficients of response that are basically telling us that banks very aggressively will enter when their competitors are exiting to some extent through a decline in their loan supply. In the aggregate, the effect of that is to offset, on average during our sample, to offset the aggregate effect by about 1/3. That will probably increase over time since the unregulated sector is growing. So our conclusions, therefore, regulatory capital requirements have very large effects on bank loan supply. I would say larger than we expected, since it's at the maximum of the range of values that we were expecting would be possible. We find strong evidence of leakages from unregulated banks. So this concern that, for example, Deputy Governor Paul Tucker has in the UK, that the unregulated, if you don't have a coordinated macroprudential regime, which of course is what's envisioned under Basel III, that you would have a coordinated regime. But if you don't have a coordinated regime where the various governments are acting similarly, then the fact that you have these banks operating in a country that aren't under that country's jurisdiction means that there could be significant leakages. We are currently pursuing two other papers. One of them looks at internal capital markets, I've already mentioned that, and the other one looks at monetary policy, comparing the potency of monetary policy versus capital requirements in their effect on aggregate credit supply. You probably remember some papers that Kashup and Stein did in 1995 and 2000 on the effect of relative bank funding costs, arguing that smaller banks, particularly banks that didn't operate in internal capital markets, had much greater responsiveness to monetary policy tightening because they were much more reliant on depository funding. We find that in our sample too. We find that same Kashup and Stein effect for monetary policy, but we find a much larger effect, much more potent effect on credit supply coming from bank capital requirements. I think I'll leave it at that and welcome the discussion. Thank you.
Thank you. Thank you very much, Charlie. Next speaker is Jose Pedro, joint paper of the Bank of Spain and Stephen Onjena from Tilburg University. And this paper carries on in the capital discussion, but it rather looks what you can learn from the Spanish experience with dynamic provisioning about how future potential macroprudential policy may affect lending. Jose, floor is yours, 25 minutes.
Many thanks, Philip, and many thanks for the invitation. Of my co-authors, Stephen Onjena is here in the audience, and the two other co-authors, Gabriel Jimenez and Jesus Saurina, are from Bank of Spain. We must say that we are receiving funding from the National Bank of Belgium, and therefore the views, our views not only are not necessarily the views of the ECB, Bank of Spain and the Euro system, but also the Bank of Belgium. Our paper is very similar to the paper presented by Kalomidis. In fact, we have the same two questions and a different setting. Instead of this regulation in the UK was a regulation in Spain, but basically the idea is very similar. So macroprudential policy basically aims at reducing the strong negative externalities from the real sector to the financial sector. And basically, as Kalomidis said, the credit cycles are a very important mechanism by which, when there is a lot of credit, they might create a crisis because banks give too much credit in the economy. This creates the seeds for the crisis. And when the crisis arrives, maybe in the system, there is too little credit, like a credit crunch. And basically, because banks don't give enough credit to corporations, there is lower investment and lower output. And basically, there are two views on these credit cycles. One view is more than the problem comes from the banks. So basically, when in the good times, banks' balance sheets are very strong, bank profits are very high, capital is very high, and that implies that there is a lot of lending, too much lending in the economy to the borrowers. And when the economy is in a bad situation, banks don't have enough capital, and this creates a credit crunch in the economy. On the other hand, there is credit cycles coming from credit demand, in which the key mechanism, instead of the bank balance sheets, would be, for instance, the collateral of the borrowers. Basically, in good times, the collateral of borrowers, real estate, for instance, is high. That makes that banks give credit to the borrowers because the borrowers are good, the collateral is good, their net worth is good, and they invest, and this creates more GDP, and this in turn creates higher value of collateral, and then banks continue lending. So this creates credit cycles due to the net worth of the borrower. So in this paper, we're going to talk about credit supply cycles coming from the banks. So excessive bank procyclicality. Basically, as I said, good times, too much credit. Bad times, because of a capital crunch, basically, banks give too little credit. So one solution could be contracyclical bank capital buffers. So basically, if banks hold more capital in good times, they will internalize more their decisions, they will internalize more the loan cost, and this will make them to be more cautious in the lending. In bad times, if the problem is that banks don't have enough capital to give credit to the borrowers, basically they will have more capital and that in that moment, built in the good times, and then because they will have that particular capital in the bad times, they will be able to continue lending to the borrowers without the support from the government. And this is basically the rationale of Basel III, as we can see here in this quote from the G20, in which basically they point out that capital serves two purposes. One, it reduces the risk-taking of banks, and second, it serves the banks to withstand shocks when there is a crisis. Basically, they will have more buffers, and this will reduce the likelihood of bank defaults, and therefore it will allow banks to continue lending. Bankers, on the other hand, see the things very differently. So basically, here in the first quote of Joseph Ackermann, the CEO of Deutsche Bank, he agrees that with more capital, obviously, in bad times, banks will suffer less, and therefore this stability might create a good positive externalities to the economy. But what they argue is that because bank capital might be more expensive, increasing the capital requirements for banks will make bank finance more costly, and this will create a negative externality to the borrowers, with very negative effects for the economy, in terms of reduction of credit supply and in turn reduction of investment. And basically, both the British Banker Association, the Financial Stability Forum, and other associations of bankers have said that the cost for the economy of these new regulations, Basel III, will be very negative and very costly for the economy. And even former central bankers like Greenspan also agree that this new banking regulation, at the end, the cost will be lower credit for good investment projects. So basically, the question that we answer in this paper empirically is, what are the effects of contracyclical capital buffers on credit supply? More generally, what is the effect of bank capital on credit supply? And whether this is different in the good times vis-a-vis the bad times. Remember that, so the contracyclical capital, the argument is that it will be good, both good in the good times by reducing credit, and it will also be good in the bad times because the banks will have that capital to continue lending to the borrowers. We will also talk about bank and firm heterogeneity. Basically, maybe not all the banks will be equally affected. Maybe riskier banks with worse balance sheets will be more affected. And maybe also there will be affected firms in a different way. Maybe smaller firms will be more affected. And finally, we will talk about real effects, whether this changes, say, the employment, the firm survival. So basically, we will argue about the real effects. And in a sense, this is the second question that, as Calomiris was saying, like these tools are for macro credit supply. So basically, firms could easily switch among different sources of finance. More regulation in the banking sector would not be harmful for the firms because the firms could substitute and will be isolated in a sense. There is a big theory on both these rationales that the policymakers argue and also the incentives and the buffers, and also what the bankers say that higher cost of equity, bank equity, will lead to lower credit supply. And also, there is not only bank capital in general, but also the contracyclical capital in both models with agency problems and without agency problems, but with investor sentiment. Now, it's clear that this question is very relevant for policy. It's also relevant for theory and for the in a sense, the commercial bankers. Now, the issue is how to identify this change in regulation, how this will impact credit supply. First, you need shocks to these contracyclical capital requirements. So you need change in laws that create the shocks that we can analyze as researchers. And the second thing, you need a comprehensive loan-level data to pin down, to identify credit supply. So basically, it's difficult to identify credit demand and supply. These changes of regulation are never completely exogenous. In banking, we don't have what is called randomized experiments. So therefore, you need to control very well for demand in order to truly isolate the changes from the regulation on the credit supply and then on the real effects for the economy. And as the paper of Calomiris, we also argue that we have a nice natural experiment, which is this regulation that was in Spain, introduced in 2000, modified in 2005, and also modified in 2008, which is these policy experiments with dynamic provisioning that exogenously change bank retained profits in good times to be used in bad times. Dynamic provisioning is provisioning over and above specific and general losses. Basically, they want to have like a neutral provisions over the cycle. So you are going to increase in good times the provisions over and above the specific and general, and you will be able to reduce the provisions in the bad times. So this will be completely contracyclical. And the reason is because there is an empirical fact, which is after a strong credit growth, then there come the NPLs, the high NPLs. And despite of this, provisions are always very low in good times, and they are always very high in bad times. And you are creating here procyclicality for the bank balance sheets with important implications for credit growth. So the aim of this policy is to smooth this cycle. And second, we have a comprehensive credit register, the credit register of the Bank of Spain, and which allows us to identify credit supply. And the nice thing is basically we have all the loans in the system. So basically we can have this policy affected, though it was identical for everybody, because banks have different loan portfolios, it affected differently different banks. So we are going to compare the lending of a bank more exposed to the shock vis-a-vis to a bank less exposed to the shock, lending to the same firm at the same time. So the demand will be identical because we are going to talk about the same firm, the same borrower, at the same particular quarter of a particular year. Now, the differences in lending will be due to credit supply and will be due to this different shock from the regulation. And what we find is basically that contracyclical capital buffers reduce the cycles, the volatility of credit supply cycles, and they are very good for macro implications because despite that there is, so basically first, there is a reduction on credit supply when capital is increased, as the bankers, for instance, said, though when the times is bad, there is an increase in credit supply, basically. So in the crisis is good, credit supply goes up. In the good times, credit supply goes down. And this is both volume, prices, maturity, and collateral. And in particular, weaker banks are more affected. Basically, if you are a weaker bank, you will even reduce more the credit supply in the good times. And in the bad times, you will not be able to, so if you're a weaker bank, a bank with higher NPLs, lower size, in the good times, you will increase credit supply with more capital, but not so much as the strong banks. And that's also because in the crisis times, not only capital regulation is important, but also the market regulation, in the sense that market might ask for weaker banks to have higher capital. Some buffers, in that case, could be higher. Now, this is the first thing. The second thing, which is very important given that the purpose of macroprudential is the macro economy, for firms, the overall effect is going to be positive. And this is a key result. So in the good times, despite that banks reduce credit supply, firms can substitute with other sources of finance, like trade credit, debt, and other instruments. And therefore, employment, firm survival, firm asset growth will not be modified. So, in a sense, going to the debate, if we would be in a debate, not so much in research, so it's true that higher capital regulation reduces the credit supply of banks, but firms can substitute, and therefore the real effects are very limited. However, in the bad times, like right now, if banks have more capital, this will pass the positive shock to the firms. And basically, the firms that are associated more to banks with low capital will have lower credit availability, will have more reduction of employment, lower increase in the asset side, and there will be less firm survival for the firms associated with banks more affected, with less capital in crisis times. So basically, the overall result is very positive in a sense, for the regulators, for the policymakers, and countercyclical capital will be very good for the economy, for the final economy, for the macroeconomy. And let me say finally that there are stronger effects for smaller firms, both in good times and in bad times. So for the rest of the talk, how much do I have? 10 minutes. I just want to say, I want to talk a bit about the policy shocks, so for you to understand better what dynamic provisioning is. A bit more on the data and the empirical strategy to convince you that we can identify credit supply. And I think I will not have much time to the results, so I will again summarize the results, go to our contributions, and then I will conclude with the policy implications. So basically, in July 2000, the Bank of Spain introduced, put in place this dynamic provisioning. At that moment, in 1999, Spain had, among the OECD countries, the lowest provisions in the OECD countries. And there was some credit growth already in Spain. So basically, because of this empirical fact that after strong credit growth, then comes the NPLs and the provisions, and at that time, in the good times, the provisions were very low, they put in place these countercyclical provisions, which was to raise the provision in the good times to later on be able to reduce it. So it was introduced in mid-2000. This was an increase in capital requirements, so it was a contractory shock. It was modified in 2005 for consistency with accounting, and that was an expansionary shock. So in 2005, Spain passed in 1999 to the lowest provisions in the OECD. In 2005, was the country with the highest provisions in the OECD. And at that moment, they reduced this dynamic provisioning. So we have another shock. And finally, in the middle of the crisis, so these provisions have an upper floor and a lower floor, upper limit and a lower limit. So basically, in the crisis, they was relaxed the lower limit, and this was also creating a shock that we analyzed. These provisions are forward-looking. They are before that any loss arrives. They are counter-cyclical, build a buffer in good times to be used in bad times. The increase of provision in 2000 was over and above, as I said, of specific and general loan law provisions. And in crisis time, there is, as I said, a regulatory reduction of this type of provision. So it's neutral over the cycle. So it's not an increase in the level, it's just you increase in the good times to reduce it in the bad times. So it's smoothing out over the cycle. And these dynamic provisionings are tier 2 capital. So you increase, as I said, the buffer of provisions in the good times, and we will analyze both these two shocks in the data, the 2000 introduction and the 2005 change. Then, once the specific losses arise in a crisis times, you can draw down from the buffer you created, and we will analyze this in the crisis. And then we will analyze a change also of this law within the crisis. So basically, difference to the previous paper, we analyze both the change in policy in the good times and the change in policy in the bad times, to see both the good times part of the cycle and the crisis cycle. And there is a formula, basically, that works identical for everyone, which is if the current NPLs of the bank are low relative to the average over the cycle, then you start increasing provisions. And vice versa. When the current NPLs of the bank are higher than the average over the cycle, that is, you are in a crisis time, then you can reduce the buffer. And despite that the formula is identical for everybody, banks were affected differently depending on the loan portfolio that they have. The empirical identification, we use a difference in difference approach. We compare bank lending before and after the shock, and we control, as I said, exploiting the policy shocks in the good times and in the bad times. Then we are going to control, as I said at the beginning, for the demand in the sense of analyzing the same firm at the same time. Basically, this will be a difference in difference, including firm time fixed effects. We have applied this in another paper. And this identifies credit supply. We will also control, as Calomiris, for other key bank characteristics. We will analyze all margins of lending, intensive margin of lending, extensive margin of lending with loan applications, and quantity, price, loan quantity, loan price, loan collateral, and loan maturity. For the policy shocks, in 2000 in the introduction, our main variable will be how much the banks have to increase in this capital over to relative to total assets. In the 2005 shock will be a change in law, and we will analyze how that, we will instrument the change in buffers of the bank by the change in the formula applied in the law. Then for the crisis shock, we'll have two things. First, how much buffers the banks entered just before the crisis started. And second, the policy change in the crisis affected more some banks than others, especially the banks that were lower with low provisions could benefit more from the change in the lower limit of provisions. That was the change in the policy in the crisis. So we will analyze which, we will separate the banks that were more benefited by that particular change in policy vis-a-vis the others. And so basically, we will analyze this in the credit register data, which is from the Bank of Spain. The Bank of Spain is both the supervisor and regulator in Spain. For instance, in 2007, there were more than 100,000 firms, 175 banks, and 600,000 loans in that particular quarter. We will use this exhaustive loan bank firm level data on all outstanding business loans contracts, including loan applications at quarterly frequency. What we are going to calculate, we are going to aggregate the different loans at the bank firm pair. So maybe one firm has different loans from the same banks. We are going to aggregate all of them. And so basically, we will work with a particular bank firm quarter triplet. And we will analyze the log change in credit volume, the maturity, the collateral, and we are going to proxy the price of lending in the following way. So basically, say a firm has committed loans with two banks. Now there is a change in the policy, and the firm start drawing more the credit lines from one bank vis-a-vis the other bank. Given that it has committed loans with both banks, this implies, by a reveal preference argument, that the price of the bank that the firm is drawing more on the credit line has to be lower than the other one. So we will use this way to analyze change in prices and the intensive and extensive margin. Extensive means that either you stop lending to a firm that you were lending, or if you were not lending to a particular firm, you start lending to that one. Basically, we're going to estimate this equation. On the left-hand side is the change in log credit from bank B, firm I at quarter T. We're going to control for these firm time fixed effects. This constant over here, this alpha, implies that we are not going to analyze in a sense, we are going to put firm time fixed effects. What I was referring to before, that our unit of analysis will be the same firm at the same time and comparing lending from different banks. And the banks will have different buffers, as I described before. Basically, in the good times, you increase the buffers, and this is going to reduce lending, so beta will be negative. In the crisis time, if you enter in the crisis with more buffers, you will be able to take more profit from the regulation, and beta will be positive. You will be able to support more lending in the crisis time. And we will have a bunch of other controls related to bank characteristics. And this will be done at the bank firm level. We will estimate downwards, you see, the same regression at the firm level to see the substitution effects, what Professor Calomiris was talking about leakage. So these will be the two regressions. How much do I have, Philip? 5 minutes. So instead of going to the tables and going to the charts and everything, I'm just going to summarize, as I did at the beginning, the results. Now that you have seen the policy, you have seen the data and the empirical strategy, let me give you again the summary of the results instead of going to the tables. So when you increase the capital in the good times, what you're going to see is there is a reduction of credit supply. The quantity of loans will go down, controlling perfectly for demand. The price will go up, the maturity will go down, and the collateral requirements will go up. So basically, it's very strong capital. Capital affects strongly credit supply. So in that sense, it's true in this debate, it's true that bank capital has to be costly, otherwise this would not happen. Now, instead, when the crisis arrives, because banks have built up this capital in the good times, they will have more capital, and they will be able to support more the lending. They will give more loans, supply, controlling for demand, and at a lower price. And this will be stronger for the weaker banks. This is important, the weaker banks, in the following sense. In the crisis, if you're a very weak bank, you will increase credit supply, but not so much, meaning that despite that policy is softer now in the crisis time, there is another market. The market is also putting pressure on the banks, and the weaker banks cannot reduce so much the capital, despite the capital requirements are going down. Second, and even maybe more important, there are positive aggregate firm-level results. And this is because, in a sense, in the good times, firms are not affected because they can substitute across different firms, across different banks, and across different sources of finance, like market debt, trade credit. And therefore, there will not be real effects. However, in the crisis time, if you're associated to banks with low levels of capital buffers, the reduction in credit supply will be tougher for you, and you will not be able to substitute. And this will imply that firm creditability will be lower, employment will be lower, total assets will be lower, and firm survival will be lower. So basically, the very strong results are coming in the crisis times for the firms. So the countercyclical capital is very good because in the crisis times, because banks will have these buffers, they will pass this credit supply to the firms, and that, in that moment, that's very binding, and with very strong real effects. Our contribution, in a sense, is to exploit the contribution of this paper, more academic, is to exploit policy shocks to bank capital, countercyclical buffers, both in good times and bad times, to identify the impact of bank capital on credit supply. This experiment is unique. I mean, it has been discussed in the G20, in Basel III, everywhere, this denied provision of Spain. It's a unique policy experiment on countercyclical capital buffers, and this is a key contribution for us. The second key contribution for us is that we have another paper in which we document credit supply cycles coming from the business cycle and from monetary policy. And this is especially stronger for banks with low capital, but in that paper, capital was, in a sense, lack capital, was totally endogenous. We didn't exploit shocks to capital. So the contribution of our paper, this paper, the one I'm presenting, is to exploit policy shocks on capital to have a causality from bank capital to credit supply and real effects. And concluding, so this paper tries to identify countercyclical bank capital buffers effects on credit supply. We exploit this unique natural experiment, which is this denied provisioning experiments in Spain over the last 10 years. We use the complete credit register to identify credit supply. We find that countercyclical bank capital buffers strongly mitigate credit supply cycles. And we find positive real effects for the firms. They are not affected in the good times, but they are very positively affected in the bad times, in crisis times. And as Professor Bocconi said, this has very important implications for, both papers, for Basel III, obviously, but also for monetary policy, in general for macroprudential policy. And let me say one thing, many times in this macro literature, they see capital as an aggregate. So the important thing there is the bank capital as an aggregate measure. What we show in this paper, like in the other paper, is that specific idiosyncratic bank capital also matters for the macro economy, for the growth. Thank you.
Thank you, Jose. We move right to the third paper. We move from capital and provisions to liquidity and bank reserves. Presenter is Warda Mirouche, who I understand just moved to the European Securities Market Authority, formerly worked at the World Bank, and the paper is co-authored with Viral Acharya from the New York University.
So it's another UK paper which exploits UK data. In this paper, we analyze bank demand for liquidity during the crisis. We ask two questions. One is, which banks increase their liquidity buffer more during the crisis and when? And what is the consequence on interbank market rates? So does this affect the rates of all banks in the system? Is there any contagion effect from weak banks hoarding liquidity during the crisis? So we use data from the Bank of England. We will argue that reserves balances of large settlement banks are a good measure of the liquidity demand of banks. We use also data on sterling money market rates and volumes. So there are two sets of reasons why I think the UK setting is an interesting setting for this analysis. One set of reasons is related to the structure of the money market and the payment system. While there are 400 active banks in the UK, there are only 15 banks that are direct members of the payment systems. Out of these 10 UK banks on which we focus in this paper. Out of these 10 banks, there are only 4 first-tier banks that play a role of intermediating liquidity in this market. So it's a very tiered structure. What we observe in this market is that there is little horizontal flow of liquidity in the second tier. In the first tier, there is a flow of liquidity between the major 4 banks. There is also a horizontal flow of liquidity from the first tier to the second tier, which means that when one of these first-tier banks is in trouble and hoards liquidity, it has the potential to have contagion effects on the whole system, as we have observed during the crisis. Second set of reasons why this is an interesting setting is the introduction of a new monetary policy framework a few months before the start of the crisis. This new framework has revealed to be too restrictive, and it has a consequence of the crisis. It has been substantially reformed. There are many aspects of this framework which have been increasing the difficulty of banks to engage in the market during the crisis period. One is severe penalties that were set on overnight overdraft. It was also very expensive for banks to borrow from the standing facility, and this has created a stigma during the crisis. Because the standing lending facility was so expensive, we observed before the crisis that few banks used this facility. And this has contributed to create the stigma during the crisis. As a consequence, the Bank of England had to undertake significant adjustments to this framework during the crisis. While originally banks were allowed to choose their reserve target and maintain this target on average over a maintenance period within 1% band, during the crisis, it has been necessary to increase substantially this band around the target to up to 40%. The bank has also undertaken other measures on which I will come back later, which were more permanent reforms of the monetary framework following the Lehman events. So what we observed in the crisis is a substantial increase in banks' demand for liquidity. In the first-tier banks' demand for liquidity, we observe a large increase in this demand around the Northern Rock events in mid-September, and a second large increase in March 13, 2008, following the Bear Stearns events. What we show in the paper is that, in the time series, the demand for liquidity increased substantially in days when payment activity is very high. This happens during the crisis, and we don't find such effects before the crisis. We also find that this effect is stronger for banks with troubled balance sheet conditions, especially banks with poor liquidity ratios, banks also with poor quality of assets. And we show that this increase in demand for liquidity caused both secured and unsecured interbank spreads to rise during the crisis, while we find no significant relationship between liquidity and interbank rates before the crisis. When we look at bilateral data, we find that the increase in rates that we observe at the aggregate is mainly driven by lenders that have a higher liquidity demand, charging a higher rate to release that liquidity during the crisis. We find no significant relationship between interbank rates and borrower credit risk characteristics. So we make several conclusions, several policy recommendations in the paper. The main conclusion of the paper, of course, is when weak banks hoard liquidity, this affects the common pool of liquidity in the system, and it and we observe as a result a contagion from weak banks to strong banks in the system. And we care about this because it has the potential of affecting rates and borrowing conditions for households and firms in the economy. The main policy implication of our analysis is that there is a rationale for central banks to intervene and provide liquidity, or to address the stigma attached to the emergency liquidity facility. Another important policy recommendation is that it's not enough to inject liquidity. There is also a need to address the solvency concerns. What we observe is that the instability is really created by weak banks hoarding liquidity in the market, and as a result affecting all the banks in the system. So the Bank of England has taken several steps towards this addressing the stigma. It has made this standing facility much cheaper than it used to be. It has also announced that there will be less information disclosed on the usage of the standing facility. It has also introduced a discount window facility, which is a collateral swap facility and allows banks to exchange gilts against eligible collateral. During the crisis, there was the introduction of a facility that was temporary, which allowed the banks to exchange toxic assets against treasury bills. And this discount window facility also accepts a broader population of collateral eligible.